Ladies and gentlemen, good day and welcome to Alicon Castalloy Ltd's earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Mayank Vaswani. Thank you, and over to you.
Thank you, Yashashree. Good morning, everyone, and thank you for joining us on Alicon Castalloy Ltd's Q4 FY24 earnings conference call. We have with us on the call today Mr. Vimal Gupta, Group CFO, and Mr. Rajiv Gupta, Head of Domestic Business of Alicon Castalloy Ltd. Mr. Vimal Gupta will cover the operating highlights and financial performance for the quarter, following which Mr. Rajiv Gupta will provide insights on the domestic business as well as developments in the global markets. Thereafter, we shall open the call for the Q&A session. Before we begin, I would like to point out that some of the statements made in today's call may be forward-looking in nature, and a disclaimer to this effect has been included in the earnings documents that have been shared with all of you earlier. I would now like to hand over the call to Mr. Vimal Gupta for his opening remarks. Over to you, sir.
Good morning to all our investors. Thank you for taking the time out to join our earnings call on a Saturday. I trust that all of you have had a chance to review our earnings documents, which were shared earlier. We are delighted to report the highest ever quarterly revenue for Alicon in Q4. Further, with revenues of rupees 421 crores in Q4, we have surpassed the milestone of 400 crores in quarterly revenues for the second successive quarter. This has been driven by efforts to develop capabilities for and serve new technology platforms in the auto industry, expansion into new geographies, renewed focus on value engineering and capability augmentation, and has been supported by positive trends in our established business lines. In prior earnings calls, we have conveyed to investors to closely track the following three themes that underscore Alicon's business transformation for insights into our progress and evolving business model. We continue to increase the share of passenger vehicle PV and commercial vehicle PV in our product mix. This has reached to 52% of sales in FY24 compared to 49% in FY23. Secondly, our customer profile is evolving with the addition of prestigious global names, including leading global OEMs and Tier 1 companies, highlighting Alicon's growth stature in the industry. Thirdly, our business composition is shifting towards expertise in design, research and development, and value engineering. Alicon now distinguishes itself by winning business based on innovation, technology, and design, positioning us in a solution provider rather than just a source of low-cost components. As we continue to adapt and innovate, these themes serve as a key indicator for investors to assess our ongoing transformation and strategic direction. Now turning to the financial performance for Q4 of financial year 24, total income reached to rupees 421 crore, that is a 31% increase compared to rupees 321 crore in Q4 of FY23. When compared with total income of rupees 406 crore in Q3, this indicates sequential quarter growth of 4%. Revenue growth has been driven by scaling up of production for new parts and new logos added recently, including many critical parts being supplied to marquee customers. The gross margin for the quarter was 54.1% in Q4 financial year 24, compared to 51.6% in Q4 23, higher by 250 basis points on year-on-year basis. This is primarily due to the improving product mix and accompanied by positive impact from the stabilizing of alloy prices at lower levels. There has been a sharp rise in employee costs, which are higher in Q4 by 33% on year-on-year basis. About one-third of this increase is due to the increment, increase in minimum wage, and new hires in line with operational growth. and incremental production. The larger part of the increase is due to the impact of the ESOP cost of around 3.6 crore for the quarter and 14.4 crore for the full year period, which is a non-cash charge. Shifting our focus on profitability, EBITDA for the quarter 4 was rupees 59 crore as increased of 78% from rupees 33 crore in the same quarter of the last year. The EBITDA margin for the quarter 4 FY24 has improved to 14% in comparison to 10.3% in quarter 4 of FY23. After absorbing the sharp rise in employee costs and increase in other expenses, I am pleased to share that we have reported an improvement in the EBITDA margin by 370 basis points on year-on-year basis and by nearly 100 basis points on quarter-on-quarter basis. Finance cost was higher by 27% on year-on-year basis from 8.6 crore to 10.8 crore. In line with the increased borrowings and higher interest rates. We also witnessed an increase in the depreciation, which was higher by 25% on year-on-year basis from 16.7 crore in quarter 4 last year to rupees 20.9 crore in quarter 4 of FY24. The increase in depreciation has been driven by addition of new assets as well as leasing some machines which have been adjusted over a period of maximum useful life of 5 years as per prevailing accounting standard. Thirdly, we re-evaluated and shortened the useful life of some other assets, which has also contributed to increase in the depreciation. Despite higher finance cost and depreciation, PBT has increased by 2.5 times from rupees 8 crore in quarter 4 last year to 27.4 crore in the quarter 4 of FY24. Profit after tax for quarter 4 FY24 was rupees 20.5 crore as compared to 9.7 crore in quarter 4 of FY23, higher by 112% on year-on-year basis. On a sequential quarter, profit after tax was higher by 23% from rupees 16.7 crore to rupees 20.5 crore. For the financial year 23-24, total income was rupees 1,563 crore as against 1,405 crore in the corresponding period last year, growing by 11% year-on-year basis. The gross margin for the full year was 51.5% as compared to 49.2% in FY23. EBITDA for the financial year 2024 stood at rupees 199 crore against 157 crore in FY23, higher by 27% year-on-year basis. Some of you would recall our prior earnings call where we had indicated that we will increase the EBITDA margin by 100 basis points in FY24. I am pleased to share that we have improved the full year EBITDA margin by over 150 basis points to 12.7 in FY24 from 11.2% in FY23 based on our reported numbers. We continue to remain confident about the upward direction in margin given the improving product mix. There was a sharp increase in the PBT which increased by 31% year-on-year basis from rupees 62 crore in FY23 to rupees 81 crore in FY24. Due to the tax adjustment in the prior period caused by the shift from the old tax regime to the new tax regime, the increase in profit after tax for the financial year 24 was 19% year-on-year basis as it is increased to rupees 61 crore against 51 crore in the last year. In terms of capex, we have spent around rupees 30 crore during the quarter 4 and aggregate of 114 crore during the financial year. This is largely due to machinery for production as well as the investment into new product development and for our maintenance capacity. Given the heightened level of activity at present, this is slightly ahead of our target capex deployment of around 90 crores indicated in the start of FY24. Coming to the outlook, looking ahead, we envisage revenue growth of around 15% in FY24-25, which result into total income moving from 1,560 crore in FY24 to around 1,800 crore in FY25. This is predicated on the healthy pipeline of SOP from the new product and the new customers. Further deferment of volumes during FY24 will now contribute to the revenue in FY25. Thereafter, we are poised to take the business to newer heights as we aim to deliver a revenue of over rupees 2,200 crore by 25-26. This equates to a CAGR of over 16% over a period of 3 years. Our confidence stems from the new orders which we have received and discussions with the customers on new technologies and solutions. We believe we have a strong runway for growth as passenger vehicles penetration in India is still very low at 32 units per 1,000 people, whereas China has reached a level of 223 units per 1,000 people, or 7 times of India. Countries like Germany, Japan and US are at penetration level of that is 20 times than that of India. Thus, India will remain a strong growth market for a while, and other countries will offer opportunities that are a combination of growth and replacement. In addition to the above growth of the vehicle market in India, it is estimated that by 2030-31, the split of passenger vehicles will be 60% of ICE, 25% hybrid and 15% battery electric. This indicates that the ICE remains relevant and will continue to grow. Hybrid also provides a compelling opportunities as does the EV or carbon neutral opportunity. Alicon is in sweet spot as it is well positioned with high content per vehicle in all 3 technology verticals. Even as indications remain that 4W growth will be substantial, we are also excited by the opportunity ahead for commercial vehicles given the projected spend on infrastructure and the trends in urbanization. To give you a glimpse of how we are already capitalizing on these opportunities, I would love to share that we are witnessing a significant traction EV volume and are engaged in crucial projects to boost our production capabilities. For example, the EXR prototype we developed for JLR, we will enter mass production this quarter from our plant in India. This product has enhanced our technological capability and enriched our know-how in offering thermal solutions. The market is also shifting towards hybrid technology, and I am pleased to report that we are leading this transition. Our cylinder heads for Toyota are designed specifically for their hybrid models, reflecting our advanced position in this technology. As hybrid technology gains broader acceptance, we anticipate further volume increase. OEMs like Maruti are also embracing this trend. Our strategic focus on future-ready technology and innovation has positioned us ahead of the curve in EV space, and we are now applying the same approach to hybrids. Additionally, our concentration on critical components, particularly in the EV sector, has allowed us to secure significant contracts, setting us apart from competitors in this segment. We also anticipate further traction from global customers such as Dana, Mahle and Tenford, even as domestic two-wheeler customers are showing initial sign of revival in demand. In addition to the growth from the increased volume and therefore revenue, we also expect to deliver an improved margin profile. We have already mentioned our aspiration to take the EBITDA margin to around 14%, which we have already delivered up in Q4 of financial year 24 itself. Lastly, we are looking to drive efficiencies across the balance sheet and in working capital, which will contribute towards enhanced return ratios too. On that note, I would now like to hand over to Mr. Rajiv Gupta, who will talk about developments in the domestic business and share highlights for the global business.
Thank you, Vimalji. Greetings to all of you. In Q4 FY24, auto dispatches for the domestic industry showed an improved performance, especially the two-wheeler segment, which witnessed healthy double-digit YOY growth. This includes 10% growth in the passenger vehicle segment in Q4 on year-on-year basis, 26% growth in the two-wheeler segment on year-on-year basis, and 1% degrowth in the commercial vehicle on year-on-year basis. Within the passenger vehicle segment, there is clearly dominance of UVs, with both customer interest and market share steadily rising. Importantly, we are witnessing a trend where customers who were on the fence with regard to purchasing of EV now considerably shifting to hybrid or ICE vehicles. This is starting to positively impact demands for traditional products. In Q4 FY24, the retail volume of commercial vehicles saw a marginal decline. We believe this is largely due to a shift towards higher tonnage trucks, resulting in increased payload capacity but impacting the volume of LCV and MCVs. Further, two-wheeler trend to witness a pickup in volumes ahead of the election, given the on-ground activities required to be undertaken across the country. The outlook for two-wheelers is expected to be positive in FY25 too, as traction is shifting from EVs to ICE products. Coming to some of the key business programs this quarter, for Maruti, as indicated in the prior quarter, we witnessed ramp up in the volumes during the quarter as one of the cylinder heads we supplied moved into start of production. Further cylinder head for another model completed a validation stage and is set to go in SOP in Q1. The volume for both cylinder heads combined will provide significant volumes increase in FY25 from Maruti Suzuki. Further, we will also be supplying to their Gujarat plant next year. With respect to the supply of cylinders to Stellantis, which commenced in Q3, it has now moved into mass production in Q4. As we had indicated, these will be for domestic market and will also be assembled and exported to Europe. Stellantis is seeking to create an engine manufacturing hub in Hosur in India, and Alicon is a single source supplier of the cylinders for those engines. As anticipated, volumes have shown an initial pick up in Q4 and we are set for a complete ramp up in FY25. The outlook for two-wheeler volumes is also increasing, and with election expenditure combined with outlook for a normal monsoon indicates that the rural demand may sustain. In that light, we anticipate that our key two-wheeler customers will increase their requirements. While we have indicated a focus on 4W business and higher value-added products, we remain steadfast in enhancing volumes in the two-wheeler in order to sweat our assets and operate our installed capacities at optimum levels. We also see some revival in momentum of the non-auto with the increasing spend of the government, infrastructure and defense, and the renewed vigor of Make in India campaign. As you may be aware of the last several years, we have been supplying aluminium wheels to enable lightweighting of the battle tanks. With a healthy level of demand witnessed for our products catering to the defense sector, we have added 2 parts for the wheel to be supplied over next 3 years. These pertain to regular size tanks as well as for the larger tanks, as we have indicated in last quarters. In the global business, we have shared that the prototype of a E-axle Jaguar Land Rover was approved and supplies were ramped up in Q4. which has contributed to the upward momentum during the quarter. The production of the battery housing of Jaguar Land Rover is also progressing well, and the production at the Alicon facility was at the peak volume during the quarter. For Daimler, we have a significant long-term package under development which was added in quarter 3, for which we expect approvals in quarter 1 and quarter 2 this year. Supplies are set to commence from 2026, continuing until 2035. Thereafter, we have added further orders in quarter 4 FY24 comprising of 6 parts from Daimler. With these developments, the global business contribution to 28% of the total revenue during the quarter 4, which is significant improvement compared to 21% of quarter 4 last year. For the full year, global business was 25% during FY24 compared to 22% in the prior financial year. The share of international business is set to improve further, as during the quarter 4 we added 12 new parts from 4 existing customers in the quarter. This includes 2 parts from the carbon neutral or EV, 2 parts from the non-auto, and 8 parts from the ICE. Of these 12 parts added, 2 parts pertain to the domestic business and 10 parts is for the global business. The new business added is in line to a strategy of a higher value add, as 94% of the business added in quarter 4 pertains to 4-wheelers. On the geographical basis, 94% of the new business added during the quarter is for the global market. For the full year, we have added 50 new parts from 17 customers. Here too, in keeping with our strategy, as 95% of the business added in quarter FY24 for the full year 24 pertains to 4-wheeler. On the geographical basis, 85% of the new business added during the full year is for the global markets. Globally, prominent customers such as Dana, Danfoss, Taco, Mahle are set to scale up the volumes. Further, we have noticed an increase in number of inquiries from global customers, and we see buyers from US, Europe indicating interest to source larger quantities of products from Alicon. There is a clear shift in the minds of global customers, and we see increasing recognition of Alicon as a partner and customer of choice for critical parts in their upcoming projects. Our recent success is with one of the global OEM, where we were able to produce a key part for them with a unique solution in a reliable and cost-effective manner, enabling them to avoid large investments required under the traditional approach. This solution will aid them in enhancing the performance of the vehicle. These successes enable creation of the partnership beyond that of simple supplier relationship, which creates opportunities to participate in the future projects. In terms of operating landscape, we see normalcy returning in Europe. Electricity and gas prices are stable and availability has also improved. In terms of raw material, aluminum prices have been less volatile than in past. During the quarter 4 24, Alicon have booked new orders aggregating rupees 150 crore. With this, our total new order booking has touched to 9,150 crore, which is executable over a period of 6 years from 2023-24 up to 28-29. On this note, we can open the floor for questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We'll take a first question from the line of Raghunandan NL from Nuvama Institutional Equities. Please go ahead.
Thank you so much for taking my question. Congratulations to the team for a wonderful set of numbers. Vimalji, Rajivji, thanks so much for the opportunity and congratulations. Sir, firstly, to Ravi sir, if you can share the segmental mix for FY24, two-wheeler, PV, CV.
Yeah. So coming to quarter 24, for the full year, for last year, the total sales, if we talk about contribution, around So, two-wheeler were 40% of the total pie, passenger vehicles were 33%, commercial were 19%, and non-auto were 6%.
Got it, sir. And sir, when we look at exports, roughly would CV, PV be 50-50 in exports? What could be the broad mix?
Somewhere same figures, but we'll review and get back to you on this.
Thank you. And what would be the EV share, sir, in FY24?
EV was 12%.
Wonderful. Thank you so much for sharing that. And in terms of the revenue outlook, if I heard it correctly, 1,850 crore for FY25 and 2,200 crore for FY26. Would that be right, sir?
For 25, it is 1,800 crore.
Okay. And the new orders to be executed as highlighted. So Maruti, JLR, Toyota, PSA, Dana, Mahle. These would be the main OEMs, sir, driving the new order execution?
Then Danfoss.
Danfoss as well. And ESOP, sir, for FI...
Then the growth of the two-wheeler also, that is going to support.
Got it. In two-wheeler, any major OEMs, sir, from whom order inflows have been strong?
So mainly that the drivers, you'll see that this Honda motorcycle, so they are growing very well, and you must have seen that they have surpassed the numbers of Hero.
Correct, sir.
So yeah, we are the almost single source. Approximately, we are supplying 88 to 90%. Our share of business is there. So there it will grow, and Hero is also growing because maybe in the pie, not, but overall numbers are growing. So they are approaching, and we are seeing the good inflow of the orders. Means the numbers, the order will be increasing month-on-month basis. There is increase in the volume from Hero also.
And particularly from Honda, the content per vehicle is larger than other OEMs, and that's a good sign where the Honda volumes are increasing. This year also they're talking about more than a double-digit growth. So that's a positive sign where we are working to materialize in this financial.
And would it also include the new EV of Honda? Because there again content will increase for you?
In this financial, there's only marginal numbers at the last quarter. But as mentioned, we don't intend to enter in that segment as opportunity with the two-wheelers is very less, which I've explained in previous calls. The content per vehicle for aluminum in a two-wheeler is less, and there where we have mentioned that we would like to shift to passenger and commercial.
Got it, sir. And sir, for ESOPs, it was 14.4 crore in FY24. What is the expectation for FY25?
It is around 4 crore.
Got it. And given that for margin outlook, if I take for FY25, There is some increase in freight cost